All righty, folks. It is Fed Day. It is actually 8 a.m. Pacific, so we are 3 hours away from learning what the Fed is doing and 3.5 hours away from the press conference. But before that happens, we're going to talk to Anna Kelly and give our predictions on what might happen. How you doing, Anna?
I'm great. So good to be here with you today. Always
I
fun on a Fed day.
It's always fun on a Fed Day. So I think we should get the easy part of the discussion out of the way, and that is what is the rate increase? What do you expect to happen today?
I do expect, like many, a quarter point hike. I think they can't do a half a point with what's happening in the banking system and potential credit crisis, which we're really not hearing enough about, the sustained risks there. But they don't want to pull a Burns and stop too soon. And they still see inflation being sticky. So I think that they come out with 25 and then they say, we're going to pause, we're going to watch and see how things trickle through. We'll keep an eye on it and we'll react to the data as to, whether we continue to hike, whether we bring down, but we think that this is going to be enough and we're going to pause. That's what I think he's going to say.
This is interesting because, and this happens a lot when you bring on experts, we don't always agree. So first
Yeah,
off, I agree we're going to get a quarter. Frankly, I've been calling five and a quarter for a year, so why stop now? But
right.
I actually think in the announcement, and probably even more in the Q&A, I think Powell is going to lean into being a hawk because he knows he can go the other way if the
Yeah.
data in May is bad. So I do not expect him to say pause. I expect questions about a pause, and it's like more work to do. I mean, core CP, or was it core CPI last week went up, broke trend. I think there's a sneaky suspicion out there that headline CPI, excuse me, will go up because the base effect is so small next month or this month. Shoot, it's in 10 days. And
Yeah.
then I don't know if you saw the ADP report today. That
No,
blew
I
it out of
didn't.
the water. Yeah, so expectations were 133 for job creations, came in at 296.
Oh, I did see a headline that jobs came in at basically double. So yeah, that's
Ah,
big. And I'll say this, I agree with you that he's not going to stop his hawkish stance. It wouldn't surprise me if he just tries to calm the markets a little bit and say, we're going to continue to watch the data. And maybe he doesn't use the word pause, but I think he has to remain hawkish for the Fed to maintain their credibility because
yeah.
they do think that inflation is going to be sticky, in my opinion, and that it's going to
Yeah.
take more time. And so I don't think he's going to like do a I'm pivoting and suddenly I'm a dove. I think he's going to say
Yeah.
this is not over, but inflation takes some time. We've done a lot of work. Let's watch and see how it comes through. But I
Yeah.
think to kind of bring it full circle, we're going to watch the data because he says that all the time. He always says the data will tell us what we're going to do, right?
Mhm.
But I do think that he continues to be hawkish, maybe not quite as hawkish as he was the last meeting.
Yep.
But I think he's going to say inflation, getting it down to 2% is our main goal. And we still have a ways to go before it gets there. And
Yeah.
we'll use the tools that we need to when we need to. So
Yeah. I
I
think
don't think
that's
we're too far off in what we think, actually.
yeah. So if we did a sliding scale, a one is, the cutest little dove you've ever seen, and 10 is the pterodactyl that was Jerome Powell at Jackson Hole. Where are you on that sliding scale, you think?
I
Like a
think he's
six, it sounds
probably
like?
at a seven,
A seven. Oh,
seven to
okay.
eight. Yeah. So I still
Oh,
think
okay.
he's pretty hawkish. Yeah, for
That's
sure.
yeah, I
Yeah.
I would say eight to 8.5. I don't think he's,
Yeah.
Jackson Hole, we're going higher. You guys are paying attention, Powell.
Right.
But I don't think he's anywhere. I think, and I think the market is set up for a dove. And they're like,
Yeah.
I don't know what they're not getting it. He's not there.
Absolutely. They're still not getting it. They're not building in the pain in the banking system that is truly just beginning. I think they think that it's under control. We're fine. Congress will come up with a, debt ceiling plan and inflation's coming down and we're going to have a very mild recession and we'll be fine. I don't think that that's what Powell wants. And we've kind of talked about this from the beginning, at least a year and a couple of months. We've been talking about the fact that they are going after wages and jobs. They feel like they need to prevent a wage price spiral. They can't control energy costs. They can't control its trickle down into products and food. And so they're going after services and they're going after wages. And in order for that to happen, they need to create a recession. They don't want to say that they're trying to create a recession, but they need to see unemployment come up, layoffs start to begin, and wages starting to come down, payroll raises not to happen, even though inflation is happening. Until they start seeing that level of pain and the consumer is forced with fear from a recession to really pull back and stop spending, they're in a kind of a losing battle because they're only targeting one area of the economy. So in my opinion, that hasn't changed. And Powell still, without saying it, has basically been telling us we're going to keep at this and it's going to be painful. What he means is we are going to have a recession. And I personally think that recession is going to be more painful than a very mild recession that some are expecting, because the Fed needs the recession to help do the job that the Fed can't do simply with raising interest rates.
Yeah. So the next thing I think people will be looking for is Jerome Powell's take on the banking crisis. I expect him to come out and just give platitudes, the banking system's incredibly strong, blah, blah,
Right.
blah, not really say anything. You see anything different there?
I don't, only because their job is to create stability and calm as much as they can. So even though we're talking about pain and recession, if you throw in, oh, we might actually default on our debt and the banks might actually fail, and we've got all these things at the same time, that creates tremendous fear. And that level of fear would not be good for, banks and what the Treasury and Congress have to do. And so I think he tries to maintain calm and say, listen, we've got this under control. We have our tools. We know what we need to do. We have the cooperation of, the Treasury Department. They've stabilized the banking system. I think that they very much downplay and minimize the reality of the risks to the bank, because they just can't simply afford a bank run and make it even harder for them. So he's cool, calm, collected, trying to project, we have this under control. We know what we're doing. Trust us. It's all going to be fine.
Yeah. And then I guess the last thing to kind of wrap up Fed Day is, heading out of it, people are going to start pricing in June, right? Will we get another 25 basis point in June? So I think coming out of the meeting, I think we both lean hawkish, which probably means it's certainly going to be on the table. He won't take it off. I don't think he uses the word pause at all. But we also,
That's you and I
also, yeah, we also know that there's going to be 30 days of, I think, bad economic data coming, or 45 days. I think it's 6 weeks out. What do you think the chances that they do a raise in June, even though the market, he wants to project that one's coming? Do you think they do one?
At this point, I don't. And the primary reasons for that are because of what I believe is a much larger risk in the banking system and the credit risk, the credit crunch that's ahead. And so, banks, again, I believe are at the very beginning of this potential crisis in terms of commercial real estate loans that are on the books that may default in the next year or two, like we've talked about, as well as long dated, hold to maturity bonds that have not yet had to come to maturity and had to have write downs. And so when you look at those things, the fact that banks are trying to boost reserves, the fact that they're having to pay out higher interest rates, they're trying to, there was so much money, I don't remember the exact number, I think over $1 billion left the banking system, right? And so
Yeah.
I think essentially because of the risk to the banking system, they can't afford much higher rates without something really breaking, in my estimation. So because of that, I don't think that they raise rates again. Now, the other thing is when we talk about all of the measures of economic health, like we've talked about, that the National Bureau of Economic Research uses to date a recession and kind of tell where we are in the cycle, 8 out of 10 of those key, what I call coincident indicators, are already recessionary, like strong recessionary. They're showing these are warning signs. Everything is slowing and unhealthy with the exception of jobs and wages. And so it's like the Fed has been going after jobs and wages, knowing that all these things are, coming down. And so we would be hiking into what really could be a very deep recession just to target, wages and unemployment, which is really hard for them to do with their tools. And so I think if they continue to raise rates into already a very weakening economy, if you look at the other 8 of the 10 health markers, I think that creates too much stress and the risk that they put us in a much deeper, much longer recession than what they really probably should do. So that's my guess and my reasons for it. I think this is probably the last time, unless something really bad happens again, something that's like an outlier. We're pulled into war, with Russia and Ukraine, or China goes after Taiwan. Like with war, all bets are off. Major pandemic again, supply chain issues, all bets are off. But assuming status quo for everything else, we just kind of let this run its course. I think this is probably our last rate hike for a while.
Yeah, I'm kind of in the same camp. I think Powell leaves this meeting, the audience is going to start pricing in and expecting one, but I just think the data gets really bad in the next 3 weeks. Just
Yeah,
unquestionably bad. And then I do think after that he's going to hold all year, in my opinion.
I
With the
agree.
first rate cut probably
You
late
came to my
Q1, early
side
Q.
on that one.
You're right, I did. Anna, do me a favor. Where can people find you? We're going to talk about the credit crunch next because I don't think a lot of people really lived through one.
Great. So you can find me here almost every Wednesday and on my playlist on your channel. You can find me on social media at Anna Kelly, REI Mom, and my website, reimom.com.
Thank you so much.